Today, we're going to dissect the sophisticated architecture you need to actually optimize long-term wealth well beyond standard index investing. We are not talking about stock picking or gambling here. We're looking strictly at the math and the structural design of your investments. Because as an executive, you know as well as I do that the illusion of safety usually masks some massive missed opportunities. I'm sure you've been told a million times to just buy a standard S&P 500 fund, hold it forever, and forget about it. And honestly, for the average retail investor, that's not terrible advice. But you aren't average. Relying purely on that baseline fund might actually be your biggest structural blind spot right now. So let's dive into this and see exactly what you might be leaving on the table. Here is our strategic blueprint for today's explainer. We're going to cover 6 key sections: the cost of average, unlocking structural advantages, the growth engine of semiconductors, a deep dive VOOG versus VUG breakdown, the trap of leverage, and we'll wrap up with the executive portfolio strategy. All right, kicking things off with Section 1, the cost of average, where we reevaluate the traditional S&P 500 benchmark. We really need to start by analyzing the baseline you probably hold right now. Accepting the market average basically means you're systematically ignoring quiet capital that's compounding at totally asymmetrical rates. Just look at the stark contrast in these numbers over a full decade. The S&P 500 gives you a really robust, self-cleaning 15% return. That's solid, but check out the others. If you had pure technology exposure via VGT, you had over 23%. And if you targeted specific sectors like semiconductors through a fund like SMH, they have literally weaponized their infrastructure to deliver a staggering 34.1% annualized return over that exact same 10-year period. Guys, the difference between 15% and 34% over a decade isn't just pocket change. It's the difference between a comfortable retirement and absolute undeniable generational wealth. Moving right along to Section 2, unlocking structural advantages. Let's talk about engineering outperformance. If you actually want to beat the benchmark, you've got to understand the underlying mechanics of outperformance. We have to move way beyond basic set it and forget it allocation and start looking into funds engineered with strategic rules-based filters. So what exactly is a structural advantage? Basically, it's a systematic mechanism literally baked into the design of an index. That could mean constantly rotating into whoever the current market leaders are, or it could mean holding the absolute choke points of an infrastructural supply chain. Mathematically, it enhances your long-term returns. It ensures you're systematically holding the strongest assets and shutting the dead weight, all without you needing to sit there actively managing it day to day. It's like having a massive tailwind constantly at your back. And the data brilliantly illustrates this concept in the real world. Let's stack the core Vanguard S&P 500 VOO up against the Invesco Momentum ETF SPMO. SPMO essentially takes the S&P 500 and aggressively filters it down to just the top 100 upward trending stocks, and it rebalances semi-annually. Check out the performance difference. SPMO captures a significantly higher 10-year return at 18.51%. But, and this is absolutely crucial for your risk management as an executive, during the brutal market crash we saw in 2022, VOO drew down 18%, while SPMO only dropped about 10.5%. So you're getting higher highs, but critically, much lower drawdowns during corrections. That is a highly asymmetrical, incredibly attractive risk-to-reward ratio. Let's dive into Section 3, the growth engine. We are zeroing in on the choke points of the modern economy. Listen, if you want raw, concentrated growth, we have to look at the specific sectors that act as the literal physical foundation for the entire digital and AI revolution. The VanEck Semiconductor ETF, ticker SMH, doesn't just hold tech companies. It holds the vital supply chain choke points of the entire modern economy. It isolates just the 25 largest U.S.-listed semiconductor companies. We are talking about the heavy hitters: NVIDIA, Taiwan Semiconductor, Broadcom. These are the businesses that, without them, cloud computing and AI simply cease to exist. A $10,000 investment in SMH a decade ago turned into over $188,000 today. Insane, right? But as your advisor, I've got to hit you with the warning label here. This kind of structural advantage demands an iron stomach. It is subject to extreme volatility and cyclical drawdowns of over 30%, which we definitely felt in 2022. You are effectively trading a smooth, comfortable ride for absolute market dominance. All right, Section 4, the VOGG versus VUG breakdown. Let's find the ultimate large-cap growth vehicle for you. We really need to nail down the core of your growth allocation. So many investors just blindly pick one Vanguard growth fund or the other, but the structural differences behind the scenes matter immensely. VUG tracks the CRSP index, and it's an absolute behemoth. Massive scale, over $317 billion in assets under management, and it boasts a rock-bottom fee of just 0.03%. But then we have VOG. VOG takes a different approach by leveraging the incredibly strict quality filter of the S&P 500 committee before it even attempts to look for growth. Because of that, it offers slightly broader diversification across roughly 200 holdings, a slightly higher dividend at 0.54%, and a slightly more reasonable price-to-earnings ratio. We're looking at 34 compared to VOG's 38. So how does that structural difference actually play out where it counts? The data makes it pretty clear. VOG's slightly higher fee of 0.07% has been completely easily justified by its superior returns. Over the past 5 years, a $1,000 investment grew to $1,938 in VOOG, beating out VUG's $1,866. Plus, VOOG is a bit less concentrated in those magnificent 7 stocks, about 30.5% versus VUG's 34.7%, so it gives you a much better balanced exposure. If you're building a sophisticated long-term growth engine, VOOG's strict filtering mechanism really makes it the premier choice. Section 5, the trap of leverage. I like to call this the mathematical minefield. Okay, we've talked a lot about growth engines, but wealth preservation is just as vital. The relentless pursuit of growth can easily lure executives into some lethal, wealth-destroying traps, specifically the ones hidden inside leveraged funds. The concept you absolutely must understand here is volatility drag. Let's say you're in a 3x leveraged fund like UPRO. If the market corrects and your fund suffers a 50% drawdown, you don't just need a 50% gain to recover. Math doesn't work that way. You require a grueling 100% gain just to get back to square one. This simple math problem will completely shred long-term capital and choppy markets. And hey, you don't even have to take my word for it. The warning is literally printed in black and white by the fund managers themselves. The prospectus for UPRO explicitly tells you these instruments are engineered exclusively for daily trading. That daily compounding effect actively works against you the longer you hold it. Trying to use daily leveraged ETFs for long-term executive wealth building, that's not a strategy, it's pretty much financial suicide. We want true structural advantages, not leverage traps. Finally, Section 6, the Executive Portfolio Strategy. Let's architect your long-term dominance. We've isolated the growth drivers, we've mapped out the minefields. Now, let's pull all this intelligence together into an actionable framework. A masterfully constructed portfolio is all about balance. Step 1. Establish a rock-solid foundation. Anchor it with an ultra-cheap core, something like the SPYM ETF. It tracks the S&P 500 but comes with a microscopic 0.02% fee, even cheaper than VOO. Step 2. Deploy hybrid momentum. Inject that SPMO we talked about into the mix. It automatically captures those upward trends while cushioning you with lower drawdowns during market corrections. And Step 3. Target your growth. Allocate heavily to VOOG for a wildly diversified, strictly quality-filtered tech dominance. And then, if you've got the risk appetite for it, cap the whole thing off with a surgical 10 to 15% maximum slice in SMH for that pure, infrastructural semiconductor horsepower. So you now possess the intelligence to entirely restructure your wealth using mathematically proven structural advantages. You know exactly why average just isn't enough anymore. You know how momentum can protect your downside, and you know why using the right growth filters is absolutely critical. So as we wrap up today's explainer, I want to leave you with one final thought. Take a hard look at your current holdings. Ask yourself, is your capital merely resting comfortably, or is it actually preparing to conquer? Thanks so much for joining me, and I'll catch you in the next one.